Dave Woollam, the former Chief Financial Officer of Abil, left the company in 2010, partially due to disagreements about the company's growth strategy. He joins us now as we discuss driving change in financial services. Well, Dave, it's good to have you up here from Nottingham Road, where you now live. You haven't left the business community totally, but you must be looking on at Abil with maybe scratching your head a little. Did you keep any shares?
Alec, no, I sold my shares when I left. But I have looked on it with a degree of sadness and frustration. You know, there were many reasons why I left the business, and one of them was a sense that the company was growing too fast. There was this really strong push after the introduction of the NCA for lenders to extend term and to increase loan sizes. And whilst there was a natural thing to do, I felt that it needed to be done in steps, because we were entering into new, really new areas of risk that hadn't been understood properly yet. And taking people from a 10,000 Rand 36-month loan to a 100,000 Rand 84-month loan, I just didn't believe that those would behave in a linear fashion, and that they would introduce new dynamics and very new types of risks that we didn't understand yet. So I think that was something that concerned me at the time. There were other reasons. I decided to leave the industry. So it is with a lot of frustration and a lot of sadness that I look back now, having wondered if I could have influenced it, not on the one hand, but also knowing that I made my choices and the business made its choices to follow its own strategic path.
And have those chickens now come home to roost?
I think sadly they have. I don't want to spend a huge amount of time focusing on Abil, but Abil is a very big player in this industry. And you know, I think what happened, if one looks back, is the introduction of the National Credit Act took away this almost bifurcated industry where you had small unsecured lenders limited to 10,000 Rand in 36 months, very small parcels of loan, very tightly controlled, short term, but with unlimited pricing capacity. And then you had the Usury Act, which allowed very large loans and very broad parameters of loan terms and size, but very restrictive pricing controls. The National Credit Act brought those two together, and the aim was to harmonize the markets into a single unified market. But what I think happened is the unsecured lenders moved up too quickly and started to move into the territory of the sort of maybe the bigger lenders, and the big lenders moved down too quickly and came into the unsecured space. And they almost collided in this space where suddenly people were being offered 40, 50, 60, 80, 100,000 Rand loans. And I don't think there was ever a real understanding of, well, what are these people borrowing this money for? You know, when you're lending someone 100,000 for a house, well, it's a very real and a very logical thing to do. When you're offering someone 100,000 Rand just without asking a question, I wonder whether there needed to have been more responsibility by lenders to understand what the uses of these credit are. And I went myself and personally did some, in fact, as recently as this weekend, and went into a lender and asked for a 10,000 Rand loan. I pretended I was a farm manager and dressed a bit scruffy in Nottingham Road. You can get away with that. And they, after 5 minutes, they offered me 105,000 Rand. And I said I wanted 10,000. And I said, no, but I only want 10,000. They said, no, but you qualify for 105,000. And that's kind of tells me what's happening in the industry is just too much supply coming out too fast. And people who are sort of maybe suddenly see bright stars in the eyes about what they can do with this money, suddenly take it and then wake up with a hangover.
Well, the problem with all of this is that debt has to be repaid. And
Absolutely.
when you have high interest rates, as happens in the unsecured lending market, you can get into a debt trap very quickly.
Yeah.
So where does it all end?
Well, I think what's happened in the past is that there was always a fairly high amount of a person's disposable income that was allocated to debt, but for relatively short loans. So there was this almost this discipline that had to be held for maybe 12 or 24 months. If you wanted something important, like to borrow 10,000 Rand to send your kids to school, that would have been a very sensible and a very selfless thing to do as a parent. And you paid the price through having to be very disciplined and conservative in your household spending for maybe 12 or 18 months. When the same situation arises where you're now borrowing 100 or 120,000 Rand, committing the same proportion, 50, 60, 70% of your income to loan repayments over 10 years, you wonder whether loan fatigue starts to come in. Because it's one thing to pay 70, 80% of your income for 1, 2, or 6 or 12 months. But to do that for 8 years, eventually you've got to understand the psychology of a person. They're going to long forget the utility of that loan. And they've now got this burden of the loan repayments just there and there. You and I have house mortgages, and we pay our mortgages over 20 years. But every night we walk into our house and we're reminded of how important that loan was. It gave us a roof, and it gave us something proud that we call a home. But in many cases, I don't think we're seeing the use of the debt being as well linked to an asset, an investment, or a cause which is going to lift and improve people's lives. It does undoubtedly happen, but I think there's not enough linkage between lenders trying to understand what the use of this debt is, especially on these big and long-term loans.
So how do we solve the problem then, David? Because it seems as though there's, on the one hand, financial literacy, on the other hand, financial institutions not following up as to where this money is going.
So, one of the, without doing a plug, I guess, I'm very involved in a company called Summit Financial Partners, and we are looking very extensively at how to address some of these issues. And we do believe one of them is to raise awareness. Sadly, the economic and political history of our country is that mass literacy firstly is very, very low. And with mass literacy being low, financial literacy is going to be even lower. So we have inherited a very poor level of financial literacy amongst our working population. And a lot of these people have now come into the work stream, have got good jobs, good income, but really don't understand very well how to manage the trade-offs and the choice between needs and wants, and to have financial disciplines. We're working now with Lonman on an extensive program after the Marikana incidents. They appointed us to do a very extensive financial well-being program, and the insights out of there have been extraordinary in trying to understand some of the root causes of people's frustrations and people's sense of despair when they're going home with 100 Rand in their paycheck after paying off every insurance policy, every loan, and every other requirement. And it's very hard, and then you go home and you've got no money to spend on the basic bills.
But in a way, you kind of have to believe that they were sucked into that by people who said, well, let's go on strike. Don't worry, if we go on strike for 6 weeks or whatever the case might be, and the Mashonisas got in, and now you've got all of those kind of debts to repay.
Yeah.
And of course, the strike did not deliver the promises.
Absolutely. So there's two sides to all of this, and I think I'm not here with any sense to say the industry has to take all the responsibility. Consumers have to take a great deal more responsibility. One of the things we're doing at Summit is trying to equip people with the tools to take more responsibility, to be more careful when they're considering the choices between using debt. Maybe they should be taking out insurance policies instead of borrowing money for things like funerals. Trying to help people make the right choices. But our experience is that will be a very long and slow process. And what we need right now is the industry to take a greater level of responsibility. It's going to be too slow to educate the population.
Dave, you know what happened in this continent, in Africa. There was a lot of lending that took place, money was wasted. And about 15 years ago, 10 to 15 years ago, there was debt forgiveness. Of many countries. Nigeria today is booming as a consequence of the debt forgiveness that was implemented back then. Is there not a case for this? Is there not a case to say, okay guys, we know that everybody screwed up in this, the education was not there, the industry lent money that it shouldn't have been lending to people, let's get back to ground zero, let's wipe out a lot of debt and move forward.
Look,
Can we not afford it?
I think it's too big, and it's probably too complicated to contemplate something like that now. The government is looking at miniature versions of that, like the amnesty, where they're saying take certain pockets of people and wipe their credit record clean so that they can come back into the system. And it take a long debate about the pros and cons of that. I think there are some merits and there's some logical reasons why that makes sense. I think a debt forgiveness has a lot of potential unintended consequences.
Sure.
We've got something like 150 billion of funding into this sector. Now, these are pension people's monies who have been invested. You remember, this industry is almost entirely wholesale funded. So you've got money funded by pension funds supporting these businesses. I think it needs to be slowly re-engineered and slowly reorganized. But the other side of it is that I believe very strongly that credit is a critically important tool in the economic transformation of our country. Access to credit, but it's got to be access to responsible credit.
But it's the same with any economic structure as in the African continent as well. But it is people like David Woollam who are bringing new ideas and innovative thinking to a very, very serious problem that I'm not sure we have all grasped yet in our country. Certainly the share market is reflecting it in the share price, particularly of his old company, Abil. One wonders if David had remained there, what would have happened. That was David Woollam, the former CFO of Abil.